My name's Keith Tier. I'm the US Managing Partner of a venture fund called Accelerated Digital Ventures. You can find us at accelerated.ventures. One of my jobs in the fund is to help founders tell the story for their next round of financing. And so I thought it would be useful to share an approach which I think is really good for aligning a startup with its future investor and ensuring that the future investor gets the best possible chance to decide whether to invest in the startup or not. This is actually a really hard problem because most founders are so busy running their company and thinking about what will happen this week, next month, maybe the next 3 months, that their story is dominated by the short term, especially as it relates to sales or users in the case of consumer companies, partnerships maybe. Investors, on the other hand, are very long term. They're thinking about the next 10 years, depending on the stage of their fund. Somewhere between 7 and 12 years is the length of their investment. And the question they're asking themselves is, will this company perform for my fund according to the fund's business model? And usually what that means is, could it be the case that this company could return my entire fund from a single investment? And if the answer is definitely no, it's very, very unlikely the investor will choose to invest in the company, because investors are investing other people's money for a long-term outcome that is many, many multiples returned of the amount that they invest in the company in the first place. So here's what I'm going to do. I'm going to stand back, go to the 60,000 foot level, and help you, the founder, begin to think through how to pitch your company to an investor that has that business model. I'm going to start by sharing my screen. And we'll start with some slides. And these slides are asking the question, are you prepared for fundraising? This guy forgot his trousers, so clearly he's not prepared. He's spilling his coffee all over the pavement as well, which indicates he's in a rush and he's really not calmly considering everything. So the first thing to understand is investors kind of categorize you. They try to place you along a spectrum, and this spectrum has multiple dimensions. The one I'm showing you now isn't the only possible spectrum, but it's the one I use. Other investors might tweak this in various ways, but let's take a look at it. The first is, what stage is your company at? Is it pre-product, which means that you don't even have a minimum viable product yet. You probably have an idea. You may have articulated the idea. You may have a deck about the idea. You probably don't have a team yet, or if you do, it's a very small team, and you probably haven't raised any financing yet. You're probably bootstrapped. The spectrum from that starting point all the way through to what I call metrics. Metrics is when your product has been built, both a minimum viable product and a go-to-market product, that you've gone through customer tests and proof of concepts, you've established customer desire to use your product or service, and you've figured out pricing, which is what I call market fit here. And now you're selling, and it's all about growth. Your KPIs are basically KPIs related to growth. Your company is somewhere on this spectrum, and depending on where it is, the underlying layers will kick in. If you're pre-product, you're probably a pre-seed stage company. You're probably going to raise less than $500,000. Your most likely investor is friends, family, and angel investors. And the assumption is that your recurring revenue is zero, that you haven't really gotten to revenue yet because you've yet to build a product. Going to the other side, you're a growth company because you've already got product and market fit, you have customers. You're probably going to do a Series A, which means that you're raising somewhere around or above $10 million. Your most likely investor is a larger seed fund or a VC. And your monthly recurring revenue is over $1 million. And as you can see, there's a spectrum at every layer. And if you use this, you'll roughly figure out where an investor thinks you sit. Now, the job of a startup founder is to attempt to do better than the actual stage you're at if you can, because then you'll get a better investment and some of your future success will be priced into your current company. Here's kind of an example of how different stages might blend. And this is a relatively good company. It's already got product fit. It's just achieved market fit. So the customers like the product and they're prepared to pay the price that's been established for the product, but it hasn't yet gotten into growth. Growth usually implies that a company is growing by, anywhere between 10 and 40% month over month, and certainly, well over 100% annually. And that makes it interesting to an investor. This company is probably a seed plus company, which is to say it's still in the seed phase. And these days, most startups do 2 or even 3 seed rounds before they get to an A round that a growth investor will look at. The raise amount at this pre-growth stage is under 5 million, but it's probably greater than 2, which would be appropriate for a company that's got product fit but not yet market fit. It could creep over above 5 million if everything went well, but it's not yet a $10 million raise. You're looking at larger seed funds. In Silicon Valley, for example, there's about 500 seed funds, and a lot of them are investing from a fund that's $50 million or more under management. And at $50 million or more, they can look at doing a seed plus round in the 5 million-ish raise, where they would be the largest single investor along with others. They will expect you at this stage to have more than 100K in monthly recurring revenue, perhaps a lot more, depending on the fund and the type of business you are. If you're a consumer business, they'll measure it differently. It's going to be about the rate of growth of your user base and how monetizable that is, either via subscription or advertising or some other model. So a company that fits into this kind of pattern looks something like this to the next investor. The next investor is really going to measure 3 things, indicated here by the green circles. Firstly, it's going to decide to invest in you, and at least half of that decision, 50% here, is going to be based on your traction to date. That is to say, customers going past proof of concept, customers beginning to agree to pricing. If it's a consumer business, it's different criteria, all to do with your business model, either subscription or advertising, and the rate of growth of your user base. But in either case, traction is going to be the biggest single component of the decision to invest. The next biggest component is you and your team. Does it seem that you have got to a place where your team is relatively complete with the stage you're at and you're ready to kick on? And then finally, your story. Stories are always important, but in the case of a company with really good traction and a really strong team, there isn't a lot of space left for the story to make a difference. Maybe 20%, as I've characterized here. If you do a bad story, you'll still fail to get the investment. But an okay story that meets the strength of the team and the traction should be good enough to get you term sheets. So that's a way of looking at how the next investor, breaks down the components of value. Now, most likely your company doesn't look like anything I've so far shown. It probably looks more like this, or maybe a little bit further along. Most startups are pre-product or pre-market fit, certainly pre-proof of concept. They're in the pre-seed to seed stage. They're raising the lowest amount, probably between $500,000 and $2 million, depending on the strength of the team. And they're probably raising from family, friends, angels, or seed funds, sometimes called microfunds. And they're pre-revenue. That probably looks more like your company. If that looks like your company, the next investor starts with something that looks like this. They don't know you and the team. You may have a track record. And if you do, the first thing they'll do is they'll increase this. And they might turn it a different color. Let's say instead of being red, it could be orange or even green if it's an awesome team. They'll look at your traction and they'll leave it where it is, because at this stage there's no way your traction is going to be, anything like these other ones suggest. So then you're left with your story. And because the team and the traction are so small, your story needs to make all the difference. The first thing is, it probably needs to get up to 50% of the reason, at least, that the investor will consider investing in you, at least that much. Secondly, it needs to be the case, and let's just change the team here. Let's say they get to 10% on the team. And that means, up here, if you add them together, you're at 61%. And that means how likely are they to invest? And 61% is, pretty high for a company at the very earliest stage. So your job is to improve your story, to make your story massively better than would otherwise be the case. If you can do that, then looking down below, there are funding windows. Really, in any given year, in most parts of the world, the funding windows are from February to June, from September to November. And so based on how much money you have in the bank or what your burn rate is, you need to find your funding window. And the funding window has to be aligned with how much you want to raise, who you want to raise it from, and how long that money will last you. That's always a very subjective decision based on all kinds of variables, so I'm not going to guess what it is now. So to be clear, a company that is at the earliest stage will find it hard to raise money, and certainly will find it hard to raise larger amounts of money at valuations that are further along the spectrum, unless the story can be leveraged to create massive desire on the part of the investor to invest. So what I'm going to do now is I'm going to stop sharing this screen. I'm going to show you how storytelling can be done in order to achieve that goal. Let's load a Google Doc. Let's maybe increase it by zooming in here a little bit. Let's zoom in to 150%. So storytelling is it's really an art combined with science. But the artistic part is to understand that a story's goal is to persuade an investor who most likely starts with fear of losing their money to transition through your story to a fear of missing out. If you can't do that, the investor's going to wait and see. And so here's how I think about that as an investor. The black column represents content, and the blue column tells you why you should do this content and what the goal of it is. So let's start with the blue column. Section 1, I call it the opportunity. It describes what drives your opportunity, how big the opportunity is, and why you and your company and team are the primary beneficiaries of it. It has an emotional goal, which is to make the investor, the listener, fall in love with the investment opportunity. Now, that means, just to be clear, that doesn't mean fall in love with you and your company yet. That'll come later. It's to fall in love with the opportunity. So I do that by, on the left-hand side, thinking about 3 parts to this first section. The first part is to identify inevitable trends that the company benefits from. And when I say inevitable trends, I mean, like the tide coming in the ocean. King Canute tried to stop the tide, but he couldn't. It was impossible. And if you're not familiar with the story of King Canute, you can go and Google it. Trends that are inevitable are really important. So for example, the trend towards home delivered food and convenience. It's clearly measurable. There's statistics out there, and the first companies who went down that path didn't have the benefit of trends, but the second and third ones did, and that's a huge trend. The trend towards smartphone ownership is an irreversible trend. The trend towards the global platforms, iOS and Android, that software can be shipped on is an inevitable trend. And some people will say that blockchain and distributed networks are an inevitable trend. A startup needs to benefit from some big inevitable trends. 1B, the value of that trend, the economic value, must be huge, enormous. Sometimes people call this the total addressable market. It's the ability to put into numbers how much money will shift from the way it's currently spent to new ways of spending it due to these trends. And if the trend represents a completely new business, not disrupting an old one, then it's how much money will be spent on this new business. Apple was able to do that, for example, with smartphones. It wasn't the same thing as the previous generation of phones. It created a whole new market, and it was able to look at how big it was. Or Netflix was able to do this by looking at DVD players in the home and what the market for home delivered DVDs were back in the days. Today it would be all about streaming, of course. So it's the economic size of an inevitable trend. And then in 1C, and this is the first time you'll speak about your company, and only at a very high level of abstraction, what is it that makes you the most likely, or at least one of the primary beneficiaries of these trends, and what is it that the investor should believe in trying to figure out how much of the economic value you've described could flow to you and your company? And that's your opportunity section. Section 2, moving along, has an entirely different goal than section 1. So back to the blue area. Firstly, technically, I suggest that you should describe in a machine gun style. That means roughly 10 seconds per slide, which means there can be quite a few slides. Machine gun style, what you've achieved to date. The options I've put on the left are some typical things that might go in this section, but every startup has its own achievements. It includes figuring out the idea and the concept. It includes figuring out what the business model would be. In other words, where would revenue come from and why would it be positive from a unit economics point of view. It can include the team, the founders. It can be some technology insight, like Larry and Sergey figured out link counting to create ranking on search. It could be that you understand the product and the market, that you know who the customers or the partners will be. It could be that you already have some traction. Whatever it is, it needs to be in this section. And as it says in the blue in the italics, the emotional goal of this section is to make the listener, the investor, the future investor, fall in love with you and your team and your ability to execute. So whereas section 1 is very forward-looking, section 2 is only backwards-looking. It's what you've done so far and should not include any future projections at all. It's just what have you done so far. And if you do it well, and you do it machine gun style, and your achievements are well articulated, the investor, having fallen in love with the idea in section 1 and the market opportunity, should now fall in love with you and the team. And investing is a process of falling in love with both an idea and a team. So these two sections should achieve that goal. Let's move on because you're only halfway through. The next step, emotionally, as described here in the blue, is to persuade the investor that if they give you money, you will do good things with it. And by good things, it's that you understand, in the same way that an air traffic controller understands the flight path of an airplane and the pilot understands how to get the airplane to its destination and from its starting point, that you understand those things from the point of view of your company. I call it the journey from here. And so will you be a good custodian of the capital? Well, in order to achieve that, here's what you need to do. And again, there's 3 sections. 3A is explain what your end game is. You know, if you're in London Heathrow and you're flying to San Francisco, explain where San Francisco is. And then, having explained it, you need to explain how to get there. So to do that, from a startup point of view, we start with the end game. The end game should be enumerated. That is to say, you don't just want a vision. You want a very basic, probably 1-page spreadsheet that has an economic model of how much revenue we'll be making, from what sources, and at what scale in your end game. And your end game may be 10 years from now. It could even be longer. When Reed Hastings did this at Netflix, he was able to look at the primary countries he wanted to be in, what the ownership of DVD players was across those countries, how that ownership would grow percentage-wise of the population over 5 years, how many of those people would be likely to subscribe to Netflix instead of going out to a store and incurring late fees and such, and then what the likely revenue would be if he did US first, UK second, France, Germany, and Japan afterwards. That was a model. It wasn't a forecast, it wasn't a plan, but it put his end game in numbers and allowed an investor to start thinking about the value creation that was going to happen during the life of the company. That's the end game. So it involves a description of what you will do, how you will do it, and how much money can be driven through it, how much value can be driven through it. Having done that in 3A, you now go to 3B, which is to restate the starting point. We now know that we're going to San Francisco, we know how to get there. Now let's just reinforce that we're in Heathrow, we have an airplane, it has some fuel in the tank, we have a pilot and some passengers. So briefly restate what you did in section 2, but very briefly, probably on one slide, and then go to how do we fill in the gap between the starting point and the end game. That's section 3C. And here we need to be able to explain what the product will do, key tipping points in the product, what technology will be deployed, what the unit economics will look like over this journey, what the gross revenue will look like, what the gross profit will look like after cost of sales, what kind of team we're going to build. It really is kind of a map of the next period through to the end game, which, as I said, could be as long as 10 years. So this is not, just to be clear, this is not you telling them how you're going to spend their investment. You're telling them how the entire company is going to evolve, the entire company. Now, most founders have never thought this part of the deck through. It's an exercise you need to go through, and if you go through it well, you'll look very impressive compared to most founders. Nobody will accuse you of forecasting because this is not a forecast. This is a vision expressed through a roadmap and numbers. If you do that, the investor is pretty close to wanting to write that check. And it gives you the opening to go to section 4. And section 4 is how much money you want to raise and what you will do with the money. Now, most investors, when they invest in you, their greatest fear is that when you run out of their money, you won't be ready for the next money. And if you are, that you won't be ready to do it at an increased valuation from the round they did. So that fear that their money will be trapped or orphaned is what section 4 is trying to mitigate. So when you say how much you want, the key is what you're going to do with it. I call it here the use of proceeds. The use of proceeds is the first time in the entire deck that you're coming down to the present and you're zooming into the next, let's say, 18 months. 12 to 24 months is the range, but I think the sweet spot is about 18 months. Your goal is to persuade the investor that your short-term roadmap, probably 3 months, 12 months, 24 months, looking at an evolution, will set your company up such that next time it goes to raise money, the valuation pre-money is likely to be 3x or thereabouts or better the valuation post-money on the round that you're asking them to invest in. If you can persuade them of that, they'll feel very assured that they're energizing and catalyzing your next round as opposed to losing money in a company that won't get to the next round. So you can see that this structure is heavily designed to address an investor's preoccupations. Now, if you can do that, if you can get your story in that shape, it's interesting what happens. So let's go back to the other screen share and take a look. Here you go. Because your story improved, a couple of things happen. The first is the team's impression to the investor improves significantly. So instead of being red and 10%, you're now orange and may even get to green and 10% if you're good. It's not as good as the team being responsible for 30% of the story, but in a very early stage startup, it's impossible to get to that because your team is by definition going to be incomplete. So getting to the point where the team is not a reason for fear, but is a reason for hope, that's your key. And look what's happened to the story. The story's turned green. In other words, there's no red flags there. It's as good as it could be. 50% of the reason the investor might invest being due to the story is about as good as it gets. No investor is going to only invest because of a story. But at this stage, you're still at 61%, but it's gone orange. That means you're in way better shape. And if you do a very, very good job, it could even turn green. So these are the variables that distinguish between a company that gets funded and a company that fails to get funded. And I hope what I've shown you is the story is a massive contribution. I do offer to help startups with these things. If you're a UK company, you can apply to Accelerated Digital Ventures by going to venturemarket.org and filling in an application form. We promise to review every application for funding within 24 hours and give feedback. So that's if you're a UK-based company. If you're non-UK, you can go to archimedes.studio, which is where I run my personal angel portfolio here in Silicon Valley, and you can fill in the contact form and ask me to get in touch. So thanks for listening. Hope this was useful.